Everybody, we're going to get started here in just a few minutes. No big deal. This will be did make the mistake of delayed recording this time, thank God. So we get it all it'll be all recorded from the get-go. A lot of talk, a lot of talk. Everybody's on mute, no problem. Cool. Even though I blocked off an hour and a half for this class, I don't think it'll this presentation, I should say, shouldn't take that long. It's discussion of manual underwriting and how it works with VA, which is not done nearly enough in the lending world. And most service members have no idea what manual underwriting is, how it works, what do you got to do, and they get dragged on by mortgage professionals that don't understand the policies. So we'll get started here in a few seconds. Here we go. All right, I guess we'll get started. Give me 1 second here. All right. Well, gang, I want to thank y'all for showing up for our third of 3 VA sort of masterclass. We've already talked about eligibility, credit, income, criteria, some of the other myths with VA, assets, touched a little bit about appraisals. Today there's a large subsect of veterans in the United States that I feel are not being helped on a regular basis because of misinformation that's in the environment. A lot of times a mortgage professional, a veteran will go to a mortgage professional or a lender and say, I want to get a loan, and they got a 605 credit score or 610. And immediately the loan officer's response is, sorry, our VA minimum or the VA minimum credit is 620 or it's 580. And what happens is this misconception and a myth that VA has sort of this minimum credit score. So I decided to make this last class more of a, hey, this is what VA looks at when it comes to situations such as this. It is not easy, but it does happen. We've been very successful with it. So we'll get started. You guys were on last week. You saw this. Freedom is not merely an entitlement, but a privilege earned by the people, for the people. I honor and proudly serve those who have served for me. That's actually a statement at the VA Home Loan Central Office in Washington, D.C. It's actually in their main conference room. I have meetings there on a yearly basis as a part of the National Association of Mortgage Brokers. So it's pretty cool. I serve our service members because they serve for me. That's in a nutshell. And I think loan originators get it wrong a lot because they don't take this into heart. They think it's just another loan program, and it's not. I consider myself a benefit administrator when I work with service members because it's a legitimate federally chartered benefit that they earn with their service. Here's a little bit about me, guys. 21 years of residential lending experience. I've been the #1 VA mortgage professional in New England 6 out of the last 7 years. I don't count 22 because I opened my broker shop only worked half the year in 23. So, but nationally recognized VA home loan expert. I've done speeches and presentations all over the country. I've helped over 150 condos get VA approved. Another big myth that it's difficult. I've done a lot of work with the Department of Veteran Affairs here in New England. Our area is called Vision One. I'm a past president of the National Association of Mortgage Brokers, co-author and creator of the Certified Veteran Lending Specialist class that we offer to our members and non-members. I've taught almost 1,000 mortgage originators on VA. That class is an 8-hour class. It's a deep dive into 26-7, which is the handbook, chapter 4 specifically, but we also go into chapter 8, 6, and 10. So it's a great class. Working with Massachusetts right now to try to fix the Mass VA continuing education syllabus for realtors. It's horrific. Couldn't be any. It's just a horrible syllabus for VA CE class for realtors. Misinformation, incorrect associations of federal bills, missing information, missing classes of service members. It's just really bad. So hopefully we'll have that buttoned up and a better syllabus put together for the end of the year. And I helped on the Blue Water Navy Act, which is pretty cool. That was the federal statute law that changed the VA loan limits. Why use your benefit for veterans that are on the call? It's lowest rates in the industry, most forgiving credit guidelines, most forgiving for gift funds. You can get money from any place. Multiple opportunities to defend value. We didn't dive deep this time. I think I'm going to have a class specifically for the realtor community on VA appraisals, Tidewater, and reconsideration of value, how they work, how they complement one another, and how they help keep deals together. And a lot of realtors have no idea what ROV or Tidewater is, and how instrumental it is to the actual benefit. It's so important that Fannie Mae and Freddie Mac this year are now going to be releasing their own version of Tidewater. That's how good it works. Fannie and Freddie are finally saying, well, you know what? VA's got it right. Let's have a Tidewater. Let's give realtors the opportunity to defend value. Maybe their appraiser got it wrong. So we're excited about that. No loan limits. Jumbos, it's the best loan option for jumbos is VA. Lowest mortgage application denial rate, 7.2%. 99% of loan officers don't know that. I would say 100% of realtors don't know that. But in 2022, 23 numbers aren't out yet, the VA mortgage application had a denial rate of 7.2%, where conventional was 11.7, 11.2, and FHA was 11.7. So again, myth busting. Your seller has a better chance of closing a loan with a VA loan than any other loan application. I had this conversation with a realtor the other day. Prove to me why a 20% down payment loan is better than a VA 100% financing. Face value, just looking at the offer. What makes you think it's a better deal? There's not a single realtor or loan originator in the country that can face value, look at an offer, and say that 20% is a better deal. They were misled to think that through poor training and poor education, but it's not true. You might have a 20% down payment conventional loan with a 645 FiCO score, barely enough work history, and the ratios are just pushing limits, but yet the realtor will accept that offer because they think it's better because it's a 20% down payment. Whereas the VA 100% financing with a deposit might have a 798 FiCO, 26% DTI, 80,000 in reserves, but yet you won't take it because it's 100% financing. It's crazy, but it's still out there. And I guess I had lunch with a realtor in South Shore, Mass the other day, and I guess there's still realtors in Massachusetts that are putting in their listing VA not allowed. So that is a major no-no and a violation of Chapter 151B, Section 4.7, because veterans are a protected class. That's a no-no. So lots of limitations on fees and charges for veterans, 100% financing, 1 to 4 unit. Condominiums are very, very easily approved. So it's a great subsect of potential VA properties. I just wish most of the realtors that list condos would do their job a little bit more, take one step further, actually put in the condo association name. Let us know if it's managed by a management company or self-managed. Help us get some more information up front, so that way we can make a proper assessment of the situation. VA's increase in business has been just astronomical since 2010, over 650% increase, and Mass has the lowest utilization ratio in the country. So there's a lot of opportunity for realtors to help veterans en masse and for veterans to use their VA benefit. Average VA, 722 FICO, 40 DTI, $54,000 in liquid assets. That's from VA. These aren't my numbers. This is VA numbers. That's incredible. I mean, that's a great loan right there. But who cares if it's 100% financing? That's your DTI is 40%. I'll take that all day long. And with VA, there was an average of 20% for a down payment for most VA transactions. A lot of exempt veterans because their disability, that means more money, more income. Average close time, 32.9 days for conventional, 43. So VA was closing faster at a lower denial rate with quicker turn times and appraisals. And yet realtors will say, no, it's a worse transaction. I will say that the needle's starting to move a little bit. People are starting to come around a little bit more, the realtor community around here. Probably because this bald guy that I am who I am has been running around like, screaming at the top of his lungs. I hope to think that it's moved the needle a bit. And 41% of all VA loans are made to first-time home buyers, and 91.5% of all VA purchase appraisals met or exceeded the contract price, which is the exact same number for conventional. So there is no difference with VA in that. So veterans and credit under 620. This is a huge opportunity to help veterans by partnering them with the appropriate lenders or mortgage professionals that understand that they're not bad. They're not a credit risk in many cases. Some are. In many cases, with a little bit of guidance and education now, they could be ready in 6 months or 9 months or 12 months or 24 months to become homeowners. It's just that they don't get any education. There's nobody out there teaching veterans with credit scores under 620 how you buy a house. Like what's going on? What's the process? What do I have to do? One thing, veterans are very task-orientated individuals, men and women. If you set them to a task, they generally do it. That's because that's the nature of the world that they lived in. They were given an order and they did it. Take the hill, they took the hill. Go do this on the base, they do that. You have to have it done by this, they do it. Most of the time when I tell a veteran of the documents that I need, it is literally 24 hours, racked, stacked, highlighted, pinned, posted. It's beautiful. So they make it very, very easy to work with. So the credit score in the 620 thing is you can't get a VA loan with a lot of lenders. Lenders and I'll call them out because they're horrible. Veterans United, one of the worst in the country. I would never, ever, ever send a veteran there. Yet they market like they're the best. Navy Fed, USAA, they don't work on weekends. So they're not giving any sort of education or assistance on the weekend. So local experienced VA mortgage professionals can help make this happen. So all these slides will be delivered. I'm going to send them all out. I have the 3 PDF files. I was going to send them out last week. I just figured I'd just send it to everybody in one shot. This is pretty cool. So top 10 credit scoring myths. Checking your own credit will hurt your score. That's no. You need to carry a credit card balance. I get that a lot. That's not true. You can actually go out, use your credit card, put $500 on it, and then 3 days later it posts, pay it off. That counts as utilization. That counts as actually having a credit history, which is great, so that's important. Closing old credit cards will improve. We all know that's not true. That's bad because that destroys credit history, increases utilization ratio. All debt is bad for your credit. Nope, not all is bad. A good mix is very helpful. Certainly can improve your scoring, and making more than the minimum payment doesn't affect your score. That's not true either, because if it doesn't affect your score. By paying it down faster, you increase your utilization ratios, therefore reduce, my apologies, and therefore you will have a better credit score 1 month, 2 months, or 3 months out. So it's very, very important. Income doesn't affect your income affects your score. Does not. Paying off negative record will remove it. That does not. Why do you think credit collection companies in the Commonwealth will call you all the time? If you send them 1 penny towards a debt, it restarts the statute of limitations and they can start collecting it all over again for 7 years. So or 10 years. Every state's different for the statute of limitations. We all know you don't have one credit score, but these are the top 10s that I found doing some research. Co-signing a loan doesn't mean you're responsible. That's not true. If you make somebody an authorized user or a co-signer, they're responsible for that debt. And then marrying someone with bad debt, I've heard this quite a bit too, will lower your score. Not true. Joint accounts will, but not necessarily having somebody as a spouse with bad credit will impact your score adversely. It's not true, right? So before we can figure out and explain how a manual underwrite works, you need to understand how loans are approved. And this is something that a lot of people don't understand. Most of the pre-qualifications that are written out there today, whether it's a pre-approval or pre-qual, we can debate that all day long. They're really one and the same. But really, pre-quals and pre-approvals, for the most part, have very little weight because it's just an initial assessment by a loan originator. It has not been vetted or no credit decision's been issued. So therefore, it's really sometimes not worth the paper they're written on. It's just a very basic assessment. In Massachusetts, the only person that's allowed to issue a pre-approval is an underwriter after they've issued a credit decision. So you'll see lenders, big lenders like Guaranteed Rate Fairway, Movement Mortgage, NRL, Caliber, New Res, whatever it is. A realtor will call a loan officer on a Saturday. Next thing you know, you get this handy dandy little letter that says pre-approval. It's not a pre-approval. They're allowed to write that, but it's not a pre-approval. But yet realtors think that that's better than a pre-qual, and they're really not. They're the same. They're actually very, very much similar. So how do we get to the point where we have to make a determination if there's a manual underwrite or not? And it's a function of information in a computer. So what happens is we have to use automated underwriting systems that are designed and managed and created by Fannie Mae. Theirs is called Desktop Originator, and Freddie Mac, Loan Product Advisor. You're probably saying, well, geez, Rick, why are Fannie and Freddie involved in the approval process of a VA loan? And that's a great question. It drives VA crazy that they're required to utilize the services of a non-government, like a non-VA entity, Fannie and Freddie, to issue pre-qualifications, pre-approvals, or findings on VA loans. There are thousands and thousands and thousands of veterans every year that are denied getting a home loan because they're using automated underwriting systems from Fannie and Freddie that are not specifically designed to acknowledge what VA wants and doesn't want for a loan. So it's really crazy. So Fannie Mae Desktop Originator is very credit score sensitive. If your scores drop below a 620 generally, or sometimes a 630 range, it'll give you a denial, what we call a refer. Freddie Mac does not go by credit score. Freddie Mac will actually go by the overall credit history in the file. So they have different weighting measures each organization or each computer system uses. That's why a good loan originator is going to run a VA loan through both. The vast majority of loan offices do not. They'll just use Fannie Mae. That is the most popular one, Fannie Mae Desktop Originator. But now systems are being put in place where you'll be able to, get both at the same time. And let me show you how that works. So what happens is Rick's sitting in front of a computer. I've had a veteran go to my website. They've given me authorization to get a credit report. They've entered their employment history, their income, their assets, their work history, their rental history, their military history. They've been able to enter all that in there. I take 30, 40 minutes and I hit a few keystrokes, fill in some additional data, plug a few numbers in, ask some questions on income, verifying what kind of income do we have? Is it overtime, bonus, salaried, self-employed? We put this all together. We put it into our what's called the loan origination system. And once it's all in there, we literally just push a button. And we push one button and we'll then run that loan, what we call run the loan, through an automated underwriting system. And that'll give us two findings. And you do both. You run the Desktop Originator for findings, and you run Loan Product Advisor, which was the previous one. Loan Product Advisor is Freddie Mac. Fannie Mae is Desktop Originator. Each are computer automated underwriting systems, and we'll run the loan through both of those to determine quality. So once we have all the data, we run it through our computer, and it oftentimes only takes 10 to 15 seconds, maybe 20 seconds. And sends out two different types of decisions. You could have an approved, or you could have a refer. Now, in the world of non-VA financing, if you get a refer, the deal's dead. Very, 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 very few lenders are doing manual underwriting on conventional loans, or portfolio them. If you get an approved, that is a great start. That means you're going to have, it still doesn't mean you're going to guarantee to close, because the loan officer could have inputted incorrect data. The applicant could have lied or provided inaccurate data. So therefore, it's kind of like, the old adage, shit in, shit out. If you put bad stuff in the computer, bad stuff's going to come out from a findings perspective, and therefore sort of taint your results. So you want to be very accurate about the data that you enter in there, i.e. overtime. I see loan officers do this all the time. Borrower will tell the loan officer, I make $10,000 a month. They'll just roll with $10,000 a month as a salary base income, when in fact, that $10,000 per month isn't base income. It's maybe $72,000 a year or $6,000 a month in base income, and an additional $4,000 a month in overtime or bonus. Well, lo and behold, you don't have a 2-year history, as we talked about last week, of bonus time or overtime. So therefore you can't use it. So now you just ran a loan for an approval with $10,000 a month, when in fact you only have $6,000 a month. So there's a lot of additional questions that loan originators should be asking their borrowers while they're doing this particular part of the process, so we know what kind of income. Because the results that you see here approved or refer, they will provide decision results. The results tell you what documents you need to support the decision. And if you put in just base income, it might only tell you for one pay stub and a W-2. Whereas if you put down properly, break it out, base income, overtime, and bonus, it'll give you additional findings of additional documents that are required to support that income. So it's very important that you break it down. So with VA, you are provided with two different sort of findings. One is approved. That is what we call a reduced doc, requires the least amount of paperwork and makes things easy. Now, 95% of my loans are generally approved. Then we have refer. It's not a denial like a conventional loan would be. Refer means, and it's actually called a refer eligible, and the approve is an approve eligible. The refer eligible means we're not 100% sure. There's some aspects of this file that indicate it's a potential mild, moderate, or high credit risk, but we're not going to say no. We're not going to deny it right away. We need to find out more about what it is this file is causing some discontent. Is it the credit history? Are there recent late mortgages? Was there a bankruptcy? Was there a derogatory collection or judgment? Or was there something in the file, the credit history, lack of assets? Perhaps there wasn't any funds. Maybe it wasn't didn't meet asset requirements. So it's telling you something's in there, and it's essentially referring you to a manual underwrite to have an underwriter dive deeper into the loan to figure it out. And when we have this refer, that's where the additional pain in the butt documentation requirements come into play, which drives everybody crazy. That's where it comes in massive amounts of letters of explanation, massive amounts of supporting documentation, explaining why your work history changed as much as it did. Why did you move from apartment to apartment to apartment? What happened? Why did your income go down? It's essentially sends up a red flag for an underwriter, and they say, well, in order for me to feel comfortable, and the VA, by the way, the VA in the handbook in chapter 2, it states that, the underwriters should make every single attempt to issue credit to a veteran. They should consider every single positive factor in a mortgage application to approve a veteran for a home loan. It gives the VA, out of any of the loan programs, gives the underwriters the widest degree of leniency and gray area to work to approve a veteran. VA wants to put more veterans in more homes, just like that's what I say all the time. So The refer does not mean it's a denial, but oftentimes it means a ton more paperwork. So what are we going to be doing? All right. Refer does, like I said, does not equal denied. It means now let's try to do a manual underwrite. Let's dive. Let's roll up your sleeves. Let's dive. And I'll tell you, I've done some manual underwrites where literally I spend probably 7 to 8 hours of income calculation, asset analysis, writing letters of explanation, getting the borrowers to write their own letter of explanation, me writing my own letter of explanation as to why I feel the veteran is a good credit risk, not a bad credit risk. And it's like literally, I think my next slide here, it's like you're a defense attorney. Imagine getting ready to go to court and you're like, all right, we're going to court. I've got to put this veteran in a home. And if you're a mortgage professional that doesn't spend all your time in the VA handbook or know what some of the strong compensating factors are for a service member, then you're not going to be as successful when you get to these manual underwriting processes because you don't have the necessary experiences where it made sense. And I've had some crazy scenarios where we were able to convince the underwriter that they were a fair credit risk or satisfactory credit risk. And even though the credit score was a 560, they still gave him a house because there was other things that made sense. But we are literally a defense attorney going in defending why the veteran is a good candidate when the underwriting, their prosecution, they don't want to, they do want to, but they're under policy guidelines to not say yes in some cases. I have lenders that will go as low as 500. I have a couple lenders that will consider even no score with a manual underwrite. But generally, for those that are borrowers that have sufficient credit history, a poor one, and their scores are down to 500, we have lenders that will do that. Will it be 100% financing? Probably not. Think about it. You got a 512 credit score. You got some derogatory rates in the last 24 months, but nothing in the last 12, and you're a credit risk because of the credit history. It's well within the lender's purview to require a down payment in that situation to mitigate risk. And you can't really argue. If you come to me with a 505 credit score and say, I want to buy a house, you're probably not going to get 100% financing because there's something bad happened, right? So the credit scores, I think the lowest I've ever did, I think was a 560. I think that was the best one I ever did. It was a 560 or a 559 or whatever it was. But yeah, we got that gentleman a home, and it was pretty cool. It was a really very rewarding experience to be able to help a veteran with a credit like that. That was completely explainable. I mean, it was so much. There were exasperation of his PTSD because of his job and because of what he was doing, and it was all medically documented. We had doctor's letters, and it was a very good loan. The first and foremost requirement, mandatory, there's no ifs, ands, or buts about it, is if you get the refer, if you're over here and you have this refer right here, you will automatically be required to have a 24-month verification of housing history or verification of rent. If you have not owned a home prior to this application, you will need to provide a 24-month verification of rent. Or if you're lucky enough that you had a home, hopefully that 24-month housing history is on your credit report and there are no 30-day late payments. If you got one 30-day late payment, it's over. But you have to have a 24-month verification of rent. And the lenders will have the ability to decide what comfort level of risk that they want to take with verification process of that 24-month rent history. The strictest and what most lenders will try to go for are canceled rent checks. The problem is that we have a lot of service members that do not use a checkbook. I find this in our lower ranking individuals, E1, E2, E3, E4s, non-commissioned officers. They tend to use a lot of bank checks or money orders You don't understand why, they do. But canceled rent checks are vital. And if we have 24-month canceled rent checks at $3,000 a month, and the veteran's trying to get a mortgage payment of $3,000 a month, it's kind of hard to deny them because they've already maintained and that's the best argument for me when I go to an underwriter is I say, hey, I don't care about the Ford F-150 truck late payment. I don't care about the credit card. We're not underwriting them based on their ability to pay revolving or installment debt. We're underwriting and deciding if they can pay and maintain and manage a housing debt. And it's very difficult for them to fall back and argue with me when the veteran gives us a 24-month canceled rent check history. They're like, well, that's usually my first good sign that I think I have a winning case. The second is a management company or VOR. That's just as strong. A lot of locations around here will have management companies, big rentals, Avalon and Peabody. There's places in Danvers and Beverly where the management company will provide a verification of rent, and that's very, very powerful as well. So that is a good one to have. And when I teach veterans, this is we spend a lot of time on this because they're like, well, I want to do with cash. I'm like, well, I can't prove cash. Like, cash is not king. Cash, I don't know how you got it. Did you rob a bank? You sell some coke? You sold jewelry? Where's the money coming from? How do I know it's yours? Maybe somebody gave you the cash. I don't know, but it's not. We can't use it. The lowest or the least favorable form of rent verification is the landlord letter. And that landlord letter is just a letter written by the landlord saying, Sue Doyle has paid her rent on time for 24 months with no late payments, signed and dated. We can sometimes get away with that, but the lender can, in a really drastic, extreme situation, say, no, I don't want them. I want to have rent checks. Well, I don't have them. Well, then you're not getting a house. Unfortunately, that's a tough one. But as a broker, I'm not a lender. I'm a broker. I can go to one of the 40 different VA lenders and see, hey, would you accept the landlord letter? Every lender has a different level of or a different appetite of risk that they want to take on. Some will accept the landlord letters when others won't. That's the benefit of a broker. Whereas if you go to a large retail box lender, it's just their guidelines and that's it. Brokers are by far the best conduit of financing for government loans in the United States, especially when you have borrowers with some credit concerns. So those you have three. This is why I put this slide first. Mandatory 24-month verification of rent. I tell the veteran, if you just started renting, don't bother. Wait 2 years and work on your credit. If we got a veteran that's 20 months out, hey, let's get started now. Maybe we can get a lender to grant an exception. Maybe the night that, the day that you close, you'd be making your 24-month rent. You're staying there one extra month, whatever. So this is the big one. And then sort of we work, coming down in importance. Employment history. When we receive and approve eligible, which is the good one, they're less likely to criticize or scrutinize the employment history of a service member, not active duty, but civilian life. But when you're doing a manual underwrite and a 595 credit score, a veteran, the underwriter is going to heavily scrutinize that employment history. Do they have 2 years? The number 2 in the mortgage world is synonymous with stability. So 2 of everything: 2-month bank statements, 2-year tax returns, 2-year W-2s, last 2 pay stubs if you're paid biweekly, last 2 months of corporate tax. Everything's based on 2. So a 2-year work history at the same job is preferred. That then tells us it's a stable and reliable source of income for the veteran. If the veteran has been bouncing job to job to job to job to job over the course of 12, 18, 24 months, that's not considered stable or reliable. Or it could be. It depends on what the story is behind that situation. Was he continuously or she improving their monthly income or their financial status situation? It might be. Or was that service member having some mental health, physical, emotional issues that was prohibiting them from staying or keeping a consistent job down. Hard to say, but again, we have to dive into that and figure out what's going on. Lots of letters of explanation, a detailed history from the service member as to why, without giving specific private information, but what's going on, what happened. So very, very important. But if you've got a 24-month rent history and you got a 2-year employment history, but you got a 585 credit score, something's going on, but you might be a great candidate for a home loan. So, but employment history is, I've never seen a manual underwrite with less than 12 months go through. That's just me. I've tried a few times, but definitely if you're over a year, you got a good shot. 2 years is super awesome. Okay. These are all slides that categorize what positive compensating factors are. 2-year work history, solid compensating factor. 24-month rental history, strong compensating factor. The third most important one that we see underwriters go to all the time are liquid assets and reserves. Very, very strong. That's one of the first things an underwriter will ask me is, what do they have for reserves? If I say nothing, he's got no money to his name, or she, that's a bad thing. The underwriter might say, I'm not digging that one at all. But a reserve is defined as 1 month mortgage payment. So if I tell the underwriter he's got 18-month reserves and the mortgage payment's $3,000, that means he's got $54,000 in assets. That means he could, or she could, address a variety of issues that arise while he's owning the home. He's in a good financial position. He also, that service member knows how to save money. It's showing fiscal responsibility. It is showing appropriate fiscal behavior. Again, things that go into the decision-making process of the person with the pen saying, do I want to give this person a home loan? Am I comfortable? Typically, you want to have between 3, 6, or more months reserves on a manual underwrite using any one of these accounts: checking, savings, 401 stocks, bonds, mutual funds, retirement. Those accounts that are liquid and that can be drawn upon are great compensating factors and reserves. If you start from the top and we've got 24-month rent history, a good work history, we've got solid reserves in the bank, you're turning into a good borrower. Even though you got a 580 credit score, a 560 credit score, there's some good positive factors here. So liquid reserves, liquid assets and reserves are paramount when you're going down this path of manual underwrite, on how we're going to accomplish the feat of getting them into a house. Now, DTI is is a component. I think we all know what DTI, debt to income ratio. It's a component of VA loans, but it's not the primary component of a normal approval for VA. Remember, VA primarily decides on approvals based on residual income. Residual income is gross income minus FICA, Fed, state income taxes, Family Medical Leave Act, back out a maintenance expense, back out daycare expenses, back out your debt, and back out your mortgage payment. What's left over is residual income. And there's a chart. So a family of 4 in New England has to have $1,050 in residual income every month. So we don't look at debt to income ratio generally on a normal transaction for VA. However, now we're going to come into a manual underwrite. DTI is very, very much brought back into the equation as to determine whether the veteran is a satisfactory or low credit risk. Now, they will look at DTI. Lenders will have manual underwriting caps for manual underwriting for DTI. I have a lender that'll go as high as 50 on a manual underwrite. I have 55 actually, which is very high. And that's, I begin to question whether the service member at a 54% DTI should get a house. But what if he has a non-borrowing spouse? The wife is not on the application, her husband, but they have $10,000 a month, but they just weren't on the application because their credit's really, really bad. But they bring in a lot. So that's something that would be considered a compensating factor. there are a lot of different compensating factors that are not even touched upon when you talk, because it's just they're afterthoughts. Like non-borrowing spouse brings in 10,000 a month with no debt. I've actually gotten a credit report on a non-borrowing spouse showing that they have hardly any debt, but their credit scores are bad, but they bring 10,000 or 8,000 a month. That was something the underwriter was like, wow, that's pretty cool. Like, I never thought of doing that. I'm like, well, yeah, there's 8 grand a month and they have hardly any debt. So there's a ton of residual. So they will bring debt to income ratio back into the equation when you're working on a manual underwrite. Whereas on other times on a normal VA transaction, it's not looked at as closely. It's just kind of, it's skimmed over. This becomes residual income, a very, very, very strong compensating factor. We've got all the way through the application. The veteran has the 2-year work history, solid 2-year rental history. He's got great assets. His DTI is low. He's got a 550 credit score, but his residual income, because he's 100% disabled, might be 350% over what he's supposed to have. Let's say the veteran is husband, wife, household of 2. They only need $725 of residual. But what if they have $4,200 of residual income? Well, if you take 720 divided into 4,200, that's like, I don't know, 500%. That's a lot of residual. That is a finding that the underwriter will put on their transmittal summary or their analysis form stating why they approved it, because the veteran had 527% residual income with 12-month reserves. And you see how we're sort of beginning to create a case as to why we should approve the loan and not approve the loan. But residual, very, very important. Traditionally, under a normal VA transaction, if a veteran has 120% residual, they will almost always get approved. Almost always, except, with much, much lower FiCO scores. So if, you needed, $500, if you needed $1,000 a month in residual, but you had 1,300, you have 120% residual, you're okay. But when we are doing manuals, we want to see 100%, 200%, 300% or more, because then that really begins to drive home to our underwriter, this is a loan that we should make. This is a loan that we should do. Find me a reason why we shouldn't. Okay, so residual, very, 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 very important. Okay, this is where a lot of underwriters will put a nail in the coffin and kill a deal, because there's payment shock. Well, what's payment shock? So this is a perfect example of payment shock. You're renting with your mom and your dad in their basement, and you're paying $500 a month. Credit's terrible, but you have some good compensating factors. However, the house that you're going to look to buy, a $700,000 home in Danvers, that monthly mortgage payment is now $5,000. Well, holy shit. You're going from a $500 a month mortgage rent payment to a $5,000 a month mortgage payment. That's payment shock. Why should we approve you? Well, I have all the other things. Well, you really don't, because I can't use the rental history from your mom and your dad, because how do I know you paid your mom and your dad? You don't have canceled rent checks, but you want me to use a landlord letter, but that's your mom and your dad. There's a bit of a conflict of interest there. So that's going to be a tough deal, that scenario. But payment shock, like I said in the beginning, it's very, very difficult to deny a veteran who's been paying rent at Avalon and Peabody at $3,500 a month for a 2-bedroom, and the mortgage that he or she is going to look at is $3,250. So you're actually having a negative payment shock. Your payment's going to be going down. You maintain that rent payment for 24 months, maybe 36 months. Hard for an underwriter to say you're not a satisfactory credit risk of a $3,250 a month mortgage payment when you've paid rent at $3,500 for 24 months or 36 months. That's pretty much common sense. So when we have those scenarios, that's almost like, wow, 550 credit, 2-year work history, plenty of residual income, 36-month rental history at $3,500, but you're getting a mortgage for $3,200. you have plenty of residual, you have plenty of DTI. Well, what the heck? Why is a credit score at 550? You have no recent derogatory late payments. Oh, you haven't rebuilt your credit. You haven't utilized credit effectively enough to rebuild the scores. That's why. Well, we're not going to say no to that person. That's a good satisfactory credit risk. We want to do that loan. So payment shock, very, very few loan originators even consider this because they're more focused on a paycheck than they are looking at the guidelines. And so they just don't even understand what the payment shock piece of it is. But it's very, very, very important in the manual underwriting process. The other compensating factor that goes into the manual underwriting process is the recent credit history. The VA regulation, Chapter 4, clearly states that in situations of a high risk or moderate risk borrower, veteran, the reestablishment of satisfactory credit can be considered after there's been no late payments on revolving or installment debt in a 12-month period. So you might have all of the top compensating factors for we just talked about, but you're habitually late on all your credit. It's going to give, even if you've got a rental history, it could give an underwriter pause. Why are you always late? What's going on? Oh, I'm not good with computers. I set up my online payment, didn't work. So I just was late. But I pay my rent on time. So now you have this sort of conundrum, but we'll have some inexperienced underwriters fall back on this credit history, and you can sometimes win it. That's why I put it last. You can sometimes win if you have the other pieces that sort of counterbalance and outweigh the recent credit history. You got a couple car lates, big deal. You got a couple revolving credit card lates, big deal. You have all this other good stuff. He's maintaining a housing history adequately enough. Who really cares about the recent credit history that is now sort of coming into light because the underwriter's like, what's going on? Why are you late? Why is this happening? So if we can sit with service members earlier enough in their sort of rebuilding phase and make them focus on the fact that you've got to have a clean history of revolving and installment debt for the last 12 months. Now we might be 9 months out in, we might be 3 months out from getting that, etc. So recent credit history is very, very important because it's been brought up in the handbook as far as reestablishing credit history. Now, that today was 45 minutes, but those are literally the 6 or 7 main points of a VA manual underwrite, and something that I have a class all designed for it. I'm trying to get more service members that are in that sort of low credit score realm and provide this class to them. I wanted to throw this on as like my third class to get feedback, from Adam and Jack and Sarah and Sue and Brendan and Derek, to get feedback and see if it was, informative enough as to why about the manual underwriting process, because very few realtors understand how the loan approval process begins. Even fewer understand that there's a manual underwriting process for veterans. You might actually have a veteran that says, so I want to go buy a house, but my credit score is a 590. Maybe prior to this class, you would have said, nah, you're not going to work. But now you're going to say, well, wait a minute. Rick talked about some compensating factors. Let me go to my phone and like, hey, do you have any of these? That might turn into a loan. That might turn into a purchase, or at least share the information amongst, peers and staff and whatnot. But that's what I wanted to sort of touch upon is those. And I've had these 6 or 7 compensating factors for a manual underwrite reviewed by a senior SAR VA underwriter at one of my investors. And she was like, her name's Mary Hamilton. She's like, Rick, that's spot on. So that is actually information on VA manual underwriting reviewed by a third-party VA underwriter who agreed with what sort of my position was on what we would be looking for and what are some areas that would lead a lot of credence to granting an approval on a loan. And with that, I'm going to open up the floor to questions. If anybody's got any questions about VA loans in general. I can answer anything you guys just fire away, or if you have questions specific to the manual underwriting process, or shoot. And I think everybody is off mute. Oh, they hold on a second here. Brendan's allowed to talk. Derek's allowed to talk. So everybody's got their own mute buttons on. So if you've got a question, shoot, fire away. We'll sit here for a few minutes. If nobody does, then I'm gonna let you all go. Hey, Brendan.
How's it going, Rick?
Good, buddy. What's up, man?
Not much, man. Appreciate the classes.
Good, man. You like that? You kind of, you kind of get something out of it.
For sure. Yep.
That's what I want to hear, man. We put.
Yep. Looking, hopefully, in the fall, they'll be coming to you. So
Yeah, this Sue Doyle on here is a phenomenal realtor and super passionate about helping service members. So depending on where you're looking, dude, is a great contact here. And she's been at every class that I've had. And so she's in it. She wants to help service members. So that was another sort of, I hope that I could connect. So, real estate professionals that'll be advocates for our veterans.
Thanks, Rick. That means a lot. Massachusetts, New Hampshire, and Maine, if you're in that territory, there's nothing better twice this week, and it's Monday, well, Sunday included. Have 2 new veterans in my basket to find a home for, and Rick, you'll be getting a couple of phone calls.
I love it. See, Brendan,
Yeah.
we got some great contacts. And the thing is too, Brendan, depending on where you are, if you're like Southern Mass, or if it's outside Sue's geographic area, you want to interview you want to interview the realtor. That's something else. I have a little bit of a breakout session in the class that I do for veterans where you need to interview. You want to interview that realtor, or the loan officer. Like, hey, if you use me, I'm blessed if you use me. I don't give a shit if you don't use me, because I'm not here to try to make money off people. I'm here to educate. I love the education piece. So I tell my veterans, like, if you're going to interview a loan officer, how many VA loans did you do a year? Are you familiar with the handbook? Can you recite some of the comment, some of the statute in chapter 4? Like, do you understand Tidewater? Do you know what reconsideration of value is? And if there's pause, like, you don't even use them. There was a veteran today that I got a emergency call on Saturday. He's like, Rick, I should have went to you in December, but I went on Facebook and I found this lender. It's a 3-letter word, and they're out in New Hampshire and Mass, and they didn't know what they were doing with VA. And the loan was supposed to close this week, the 16th. They had not even issued a credit decision on the loan yet. The commitment was tomorrow, the Tuesday, this 13th. Hadn't even approved it yet. The loan officer hadn't even advised the veteran on how to get homeowners insurance, or that you'd need homeowners insurance. Hadn't asked for verification of earnest money deposit, nothing. It was so bad, one of the most egregious cases of sort of mistreatment of a veteran. Luckily, the veteran's girlfriend has an aunt and uncle that are incredibly wealthy, and so you're going to get a kick out of this. Had an incredible aunt and uncle in Long Island that owned 2 very successful construction companies. To save the deal, the aunt and uncle bought the house cash.
Oh,
So they could close on Friday. That's a no bullshit scenario, because I was on the phone with this veteran for an hour and 30 minutes on Saturday, and I think I could have done it. But he was a service member that was National Guard, who had 5 deployments or call-ups in the last 24 months. So he had very little civilian employment throughout the course of the year. So there was a lot of work there to quantify what the gross income was going to be allowed to be used. But I think it would have worked, but this loan officer did nothing. Never. And when the veteran today texted both loan originators, like, what's going on, nobody ever responded back with a text. Nobody responded back with an email, a phone call, or nothing. Just left the veteran out to dry.
that makes me sorry for the language, that makes me want to puke.
Oh, it was one of the most egregious cases of sort of veteran mistreatment I've heard of in 20 years. I was like, they haven't called you yet? They're like, nope. So we told them to F off, and the aunt and uncle bought the house cash. They're wiring the funds in this week, and they're going to buy the house cash on Friday. So say, because the veteran had given his notice at his apartment. He had no place to go.
Oh, Jesus.
So it just goes to show you, you know what I mean? So, but yeah, that's like, that's one of the cases that we see all the time. So interview your loan officer, interview your realtor. If you're a service member and you're going to go out there looking to buy in whatever state of the union you're going to be buying at, because it's, you know, the too many in our industry put the paycheck before the people, and that's not the way it's supposed to be. So,
Exactly. Exactly.
yeah. Any other questions? Adam, Derek, Jack, anybody else? If not, no big deal. You know, you have all my contact information. I will get these 3 PDFs. I know I've been promising, it's been a little crazy. I will have all these 3 PDFs put together and sent out to the attendees, and you guys will have them as a resource. And yeah, if you need anything VA related, just let me know, shoot me an email. And for the realtors, yeah, you're welcome, Jack. You're very, very welcome. For the realtors on our call, happy to come out to your office, do a little lunch and learn. I have a sort of a VA, you know, myth buster presentation that I do, and you know, 40 minutes, and we kind of hit some important topics, and then that's it. But with that being said, gang, if there's no other questions, then we can rock and roll, and we get out of here in just about an hour.
Cool. Appreciate it, Rick.
You
Thank
guys
you,
are
Rick.
all very, very welcome. And yeah, with that being the case, I'm gonna stop our recording, and we'll catch you guys in a little bit.
Thank you.
Appreciate it, Rick. Thank you.
Adios, man.